Have you ever had the perfect client in mind? Someone that you look at as a prospect and think, man, if I could just get them, they would see so much value in the product I offer, the service I sell. That's the person I want to get. But you just can't seem to sell them. Maybe they just don't have confidence in you, the product or service that you offer, they don't understand it, or it's not a fit for them, whatever it might be, and you're like, man, only if I could get them. Well, today I'm going to share a case and a story about an individual who took me about 10 years to sell. Now, I've been in business, or in the industry, I should say, for a little over 10 years. So really from day one, I've been working on him. He's always been interested in what I've been doing, just my progress in the industry. When I broke off, started a business on my own, he's helped me in a number of ways from a business standpoint, but in respect to getting a policy, wasn't his thing for a long time. Now, when he started the policy, he was 59 years old. However, we were able to backdate the policy, so he had a starting age of 58. And again, it took me 10 years to get him. So if he would have started when we first connected, he would have been around 48. That's a lot of time lost. You could argue that just with a cash value life insurance policy. But that's actually one of the reasons I did not get him. What I mean when I say that, when I say, hey, 10 years is a lot of lost time, and I was overly technical, I liked the details, how to maximize the cash value, that was what I felt was my strength. He was not like that. Now, he studies returns on his other financial instruments and investments. He's very successful from a business standpoint. His business is primarily in real estate right now. He's got a net worth on paper of about $10 million. The reason why I say it's on paper is I feel it's actually much higher than that with some other things he has going on, but a net worth of about $10 million. Does very well in real estate, does very well and has historically done well in the stock market. He likes to do it himself. He's got a financial advisor as well, but he's very actively involved with his money, doing well in that respect. We talked about whole life insurance, went over policies on a historical standpoint, guarantees, the tax benefits, safe, liquid, tax-free, all that good stuff. And over the past 10 years, just wasn't a fit. Then all of a sudden, he started to look into it more, and he said, you know what, I'd like to see some options. In the past, he had just bought term insurance for me on two occasions. They were small policies, I think right around $500,000 each. That's it. That's been the extent of it. Now, what he's doing now is putting in $600,000 per year. That's broken up into two policies. And why he does it, cash value, safe, and tax-free. The liquidity piece is nice. However, he's expressly stated, hey, I won't really need access to the cash value. I like the fact that it's safe. It's money I have sitting in cash. I've got a ton of money in the market already, more than I'm comfortable having there, like I'm good. Here's my cash here, and I've got excess cash. If I need to access it, yeah, I'll leverage it with a bank or something like that. But I love the fact that it's safe, and I love the fact that it's tax-free. Now, he asked, what's the policy actually going to produce? The cash value when I look at the actual net growth, the internal rate of return. And I let him know it's going to fall somewhere between the 3 to 5% range. Here are the annualized and the average IRRs, went over that with him. And he said, hey, 3 to 5%, that's perfect for me. Just for money I don't have to think about, don't have to worry about. I was going to invest it somewhere else, but I would have earned between 5 and 6% with that investment, but that was taxable. Here's tax-free, and I don't even have to look at the thing. Sign me up. So he was interested in that, but this piece, he was very interested in. And this could very well be the reason why 10 years ago, interest wasn't quite as much because he was still in that hyper growth mode, business building. Now he's still growing and his family helps him push his business forward as well. But from a death benefit standpoint, this is his point of interest. Leaving a legacy, 100% tax-free. So as we look at the numbers, one of the things he mentioned when we went over the death benefits, he's like, hey, I've paid in this much money, say it's $5 million, and the net death benefit is $9 million and change 30 to 40 years down the road. He said, hey, you know, that's a return of only, call it 4 to 5%. I might be able to do better elsewhere. I said, yeah, you probably could. One thing to add, though, is that it's tax-free, income tax-free to your beneficiaries. And his words were, that's heavy. So he was excited about that particular aspect. So let's get into the details here. What we did in this case was break it up into two policies because one was funded 100% by him and one was funded actually by a family member in the business, second in command, that wanted to take a policy out on him. Took it out on his dad, so the son funded the second policy at $100K per year. And really the reason he did this was to have a death benefit come back to him, but still position it to access the cash value. So the younger son was going to take a policy out on him, but he said, can I take it out on my dad? Like, yeah, I'm kind of cashing in on his death, but the dad wanted him to do that, so there wasn't any kind of awkward feeling in that respect. So that's the setup they went with. 10/90 split from a technical design standpoint is what we did, meaning 10% of the 600 grand, it was actually a little bit less than that, was allocated toward premium, everything else into PUAs. Anything less than that, he would not have done it. He does as much as I stated, the cash value, the safe, tax-free, he liked that, but the death benefit is really why he's doing it. Still, he wants to see his money there. If it's not there, he's going to question it, and that's why he had not done it in the past, or he was turned off just from researching it in other places, not just through me. So let's take a look at the numbers here. Here we go. Let's give ourselves some more space. Better. So we mentioned he's paying in a total of $600,000 per year. Now that's broken up in two policies, and I will also add that he received a standard non-smoker rating. This was a case where we originally had a poor health rating, but in working with different companies, we were able to get a standard non-smoker rating, no additional insurance expenses, no rating, nothing like that. What we see here on the left, $500K per year going in for the first 5 years. Now he had many questions around this. His minimum premium is $50,000 per year. So he'd like to have the ability to pump 500 grand per year into the product, but he does not want to be billed for it. For the first 3 years, he's got no problem getting 1.5 million in. He's expressed that explicitly. He said, hey, first 3 years, I'm not concerned about that. What about after that? Yeah, I'd like to keep getting 500 in, and I should be able to through 62. After that, though, we've got 100 going in up until age 80. We're going to scroll down, but he does not want to be billed for that. So how the policy is set up, we see a funding sample here through age 80. That's how long we modeled the funding, but he's not required to make those payments by any means. First year, here's a question he asked. 500,000 goes into the policy, 438 in cash value. What does not show up in cash value? Because he's looking at it and he says, okay, don't go into the details here, Steve, but you told me the premium is about 10%, $50,000. I pay in 500, 10% would be 50,000, which would give me 450. Why am I at 438? Again, he's looking at the numbers there and questioning it from a basic principle standpoint. Well, the reason why, we've got your premium of about 50,000. It's actually a little bit less, which makes this more confusing. What we also have attached is this large term rider. Was close, a little under 10K, but close to 10K in the first year. That shrunk over time, the cost, but initially it was a large term rider. Okay, but it still did not add up to 438. We also had a PUA rider fee, which is a fee or a load on the PUA component, dumping money into cash, which pulled down the first year cash value a little bit as well. Was a little confusing, but we just went through it, took our time, he got it and said, okay, I get it, everything's maximized, let's move on. What's highlighted in yellow represents the break-even point there. So crossing over between years 4 and 5. By year 4, I've paid in 2 million, I've got just about 2 million, and this is standard non-smoker basic dividend with one of the major mutual companies. Year 5, I've paid in 2.5. I have north of 2.5 million. Then we tally up the payments here. Next year, I pay in another 100,000. I see my total right here in the total outlay column. By year 10, I've paid in 3 million. I've got almost 3.5 million. And he's viewing this just as safe and tax-free. So if I look at the annual internal rate of return, he wanted to see both. What's my actual growth that year? Just about 3%. I can do better than that elsewhere, but it's tax-free. Again, that's heavy. He liked that part. And from a realistic standpoint, he said, okay, the fact that it's tax-free, like, yeah, I could do better elsewhere, but the returns fluctuate and I got to deal with taxes on it. He's in a high income tax bracket, net worth of about 10 million bucks. Like he didn't want to deal with that. He's dealing with that in other areas. So that he was comfortable with. Not everyone will be, and that's okay. This would look much better if we shorten the funding period or if he had a preferred rating. Here's the average IRR, where we're going to factor in really the first year hit there more than anything else. Where that premium does not show up, I have a negative 12% hit. So by year 10, if I paid in $3 million and I've got just under 3.5 in cash value, that means I've earned over 10 years, 2.11% tax-free. Not that attractive from the cash value, but again, he looked at this and said, makes sense based on everything I'm trying to do, especially that I can access this cash value anytime I want, and the death benefit. He looked at this and says, the 7.625. I want that to increase. I do not want to see it decrease at any point in time, which if you're used to almost any of our videos, individuals who are interested in maximum cash value, we're always reducing the death benefit at some point in time to reduce the costs and maximize cash value efficiency. He didn't want to see that. I did show one option, but he didn't want to see it. I've got to listen to him and make sure we show the options he wants to see. So we see it continue to grow over time, because he continues to pump money in, and he may very well pump money in until the day he dies. However, up until age 80, he's like, that's good. He thinks he'll be dead by then. I don't, but he does. As we look at this, 4.3 in, 6.6 in cash value, death benefit of $9 million. Slight drop, not much, about $60,000. We did a reduced paid up there. That he was okay with. We can alleviate that, but I did want to go RPU, especially when looking at the guarantees that made it more attractive, which is important. And there's my value, just continues to increase over time. To the right, you've got the exact same product, but with $100,000 per year going in, and then $20K per year thereafter, which the son is funding. Policy on dad, and he says, yeah, I'm going to keep doing that. Like, why would I not? Can I pay in more than 20? Yeah, I'm going to keep doing 100K per year. Because the son views it more than just a death benefit. He views it, hey, this cash value, I want to be able to tap into anytime I want. This is way better than a bank account, and I've got some money in the market as well. So he's doing good in that respect, or he's doing well for himself. He looks at this. If he put a policy on himself, that would be much more attractive because he's younger. But again, he's looking at the death benefit coming back tax-free to him in the business he operates with his father. So what I want to show here, we've got two options or two more tabs with 500 and then 100 going in. I'm just going to look at the 500 just to demonstrate something, is if he decides to pivot after he starts the policy. So have you ever started something and you had this grand plan, but then life happens and things change? Yeah, who hasn't had that happen? So here's the age 80 fund, but here's the exact same policy where he stops payments altogether after 5 years. So he allocates 2.5 million in. There's the break even, identical to the age 80 fund because it's the same policy. The difference with this guy, and we've worked with people that have made this decision and this change over time, is look at year 8. He pays nothing in after year 5, 0, 0, 0, 0. But look at the death benefit drop. What we did here was cut the term rider, go reduced paid up. 2.5 is his total out of pocket. Death benefits 5.4. So still a significantly larger death benefit than what he's paid in, which is very valuable to him. But look at the cash value. Look at your IRR jump. If you go reduced paid up on a policy, you will see the internal rate of return and the overall growth rate on cash value increase. And typically you'll see that based on guaranteed values and non-guaranteed values. So I do like to show that as an alternative, even if it's in the back pocket and it's something we can pull out down the road. You never have to decide that up front, but it is a good option to be aware of because it does boost the internal rate of return. And if he shifts focus and decides the cash value is more attractive to me now, or that's a bigger driver for me as the years pass, you can make this type of pivot and you've got greater cash value than you would if he wants to stop funding it as well. So just nice to be aware of that. Now, he looked at that and immediately said, no, I don't want that. I I don't want to do that because the death benefit, I want to stay at 7.625 million. Then we did the exact same thing with the 100,000. You see the same outcome there too. But going back to this guy, there you go, everything combined. Death benefit, what's it at? It's over 9 million. That's the total amount. Granted, that part is to his son solely, just as how he has that set up. This is for all of his beneficiaries, how he wants the policy set up. So it was an interesting case because a lot of people we work with are hyper-focused on the cash value and how to maximize everything. But depending on one situation, that's where we can pivot. But the one takeaway there, if you're interested in cash value life insurance, or if you have a policy already, or if you're in the business, is that setup, that design was the same policy, was the same company, identical from where the money's going. It's the same product. The only difference is what he did or may do after he starts the policy. So we can adjust as he goes. We always talk about policy flexibility, so we can use the product as a flexible savings asset. And he can do just that. So the nice part is when we get into the product, we don't have to feel like we're locked in or committed to this huge premium. We have to follow this plan, especially if you're a business owner. Things are going to change. Like that happens no matter what. Sometimes it's for better, like, okay, I need more policies. Sometimes it's for worse, and I got to scale back. But hopefully, you found some value in that as far as the pivots and adjustments we can make over time. If you enjoyed, please hit the like button, subscribe, and as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.